We're starting on chapter 6. Well, probably won't finish it. I think we should finish the monetary unit sampling. I think there's one more problem to do on that. So we'll go through the planning and then finish the monetary unit sampling. That's it. It's kind of a chapter 5 and 6 are kind of a long one, but there's a lot of good stuff in it. So, all right. So see if you can, hopefully, you get in your email the chapter 6 handout, planning the audit. All right. And by the way, one of the things I hope that happens here is that we hopefully the rest of this kind of makes more sense. The auditing kind of makes sense. Auditing is kind of, I like teaching auditing, I have to admit that because it's kind of wacky and it's a lot of judgment, which usually you don't get in accounting. There's a lot of judgment involved as far as how do you prove something? How do you get, reasonable assurance about something and all that? But anyway, so I'm going to kind of go through this, and hopefully as we go through this, it'll make more kind of sense what we're doing. Okay, so we're talking about this as planning the audit, and this is sort of like the first step here. And you have to understand the client themselves. You understand their environment as far as what their market is and all that kind of stuff, but you also have to understand their internal controls over how do they control things. And the reason you have to understand the internal controls is you have to understand where the problems might be, where the risks might be. All right. So let's kind of look at what this would be. So for instance, kind of putting this in the context of what we did for sampling. Let's say that we have let's say we identify a risk that the account receivables are overstated. Okay, so assess the risk. So if we came up that there's a risk that the accounts receivable were overstated, maybe it could be this in general, what we noticed from last year. It could be we notice there's something different with the environment or the internal controls. It could be any number of things that say, okay, we got to check to make sure these accounts receivable see if they're overstated. That's one of the risks we have. And you have risks for a lot of different accounts and a lot of different, things that are all interconnected. Receivables, those also go along with sales. So, when you're testing for the receivables, you're also really testing for sales in that too. So you go, okay, well, what procedures do we have for that? Well, maybe we have, you might do some classical sampling and do, let's say, I don't know, what's ratio estimation. You see if those accounts receivable are overstated. We could also do the monetary unit sampling that we're still working on. So we're assessing these risks. And then, after we assess them, we're performing the audit procedures, we need to figure out whether, whether they are overstated or not. So we may do some sampling, try to figure that out, whether they're overstated or not. At the end, we'll complete the audit, and there's some end of audit completion things. We won't have them in this class, but we'll have them in the next. And if you guys take the what is it, 433 procedures on, we actually go through audit steps for each type of things like for cash and accounts receivable and inventory and all that. And after you complete the audit, the very last thing you do is form an opinion. But you need to have this evidence here to form an opinion. So perform further procedures. This is where you get your evidence, and this is what you need to form an opinion. So this is all kind of part of the planning, the audit, see where the problems might be. And then you design procedures to get some handle on it. What do we need to do to test this? And then when we figure that out, we go do the tests, and then we get enough evidence that we can wrap up the audit, but also form an opinion on the audit. Questions on that? Okay, so that's kind of the overview of it. And these two here, they go hand in hand. What did that look terrible? I'm gonna change that. Assess the risks and then perform procedures. So the risks will go into the procedures. Okay, as we plan the audit, we basically have 5 different categories of accounts. We have revenues and expenses, pluses and minuses. This is money coming in, this is money going out. Assets, anything with a value. Cash, inventory, buildings, all that kind of stuff. Liabilities, what we owe. And equity is what the owners have. So of these 5 types of accounts, which account is the easiest to prove? Which account would be the easiest to point to and say, we can prove this account?
Equity?
Close. It's actually on the balance sheet, but it's actually going to be assets. So, for instance, if you need to prove an asset like a building, you can go look at the building and see if the building is there, and then go through and figure out if they actually own the building and all that kind of stuff. So we usually start out with assets first. And then we move over to liabilities. Now, notice, so we start with it. So the balance sheet really gets beat up in auditing for the most part. If you prove the assets and you prove the liabilities, if these two, you get comfortable with these two, that they're not materially misstated, well, that tells you that equity is also not misstated, right? So the equity is actually what we use as a proof. Now, you might think, well, okay, so the equity is just kind of like the leftover thing. Well, no, equity account. Notice the equity account will prove out the dividends and income that come, from the income statement and then what they paid out to shareholders. So the equity account is very important, and that is one of the, that's why we do build the balance sheet. We start with the assets, prove those. Second easiest to prove liabilities. And if those two are okay, then the equity is okay. And it doesn't necessarily prove, they could overstate revenues and overstate expenses, but this income, this income comes over, This income comes over here. So we know that the income is probably okay or pretty close to it if the assets and liabilities are okay. There's also something else that happens in the balance sheet that is a very important thing, and that is the cash account. And the cash account is important because virtually everything goes through the cash account. You know, trying to come up with a transaction that doesn't go through the cash account can actually be kind of difficult. Almost everything goes through the cash account. You know, if you buy a truck, you know, okay, you pay cash for it. Okay, you say, well, what about if I get a loan? Okay, you get a loan. What do you pay with that loan? You pay cash on the loan, right? You know, so what if you do a sale? You know, okay, a cash sale. Well, that goes through cash. How about a sale that's on account? It goes into accounts receivable. The accounts receivable goes into cash. It's really difficult almost to find, you know, some kind of a transaction that doesn't go through cash. There, you know, you could, someone could trade land for something, or, you know, stock or so whatever, you know, but generally speaking, pretty much everything goes through cash. Now, cash is a lot of times, if you look at the line item for cash, like the amount of it, a lot of times it's very small compared to the rest of the assets. It may even be, you know, the balance in a cash might be immaterial. But because everything goes through it, it becomes a very important account for auditors to look at. So, you know, while you're proving this cash, you go, okay, well, you know, sales go through cash. Even the sales that go through accounts receivable end up going through cash. You know, if you pay expenses, they're going to go through cash. You say, well, what if we don't pay the expenses right away? Okay, they go through liabilities. Oh, wait, we do scratch that. No. Cool. I'm sorry. This is looking like a mess. Say, okay, the expenses, like if we didn't pay them right away, okay, they go into accounts payable, but then the accounts payable gets paid through cash. Long-term liabilities, they get paid through cash. Dividends get paid through cash. Inventory might also go through accounts payable and then end up going through cash. You get the idea. While you're proving out cash, you can prove out a lot of these other accounts. So especially these revenues and expenses, as you prove cash, everything from revenues and expenses virtually goes through cash at some point. So while we're proving out cash, we prove out a lot of other accounts, even though the cash itself might be immaterial. And there's another great thing about cash, and that's one of the reasons why it's very important, is that cash is an account that for many businesses, you actually can audit those at 100%, which is not true for a lot of things. Inventory for a large company, that's kind of, you know, you can't do it 100%, it's just impossible. But, you know, if a company has 500 bank accounts, you can get 500 bank statements. You know, a lot of times you can actually prove out cash pretty much 100%, pretty close to it anyways, which is very good because while you're proving out the cash, again, you're proving out those revenues and expenses and inventory and all that other stuff, simply because all those things eventually go through cash. So even though cash may not be dollar amount material, you actually look at it very closely because it affects all the accounts. And kind of a side note is also that of all the accounts that people would like to steal, cash is it. I mean, that you know, if you're whatever you're plan on stealing, cash is the universal one, but so it is susceptible that anyone can use it. However, one of the more important reasons that we do it is because it proves out those revenues and expenses better than any other account. So we really beat up the balance sheet. You know, the balance sheet is really beat up during an audit. And again, if you prove assets, you prove liabilities, equity is proved then, and that pretty much proves the income. You know, that'll also be, you know, if you prove out equity, that must mean that the income is correct. And even if the revenues and expenses are off by a little bit, whatever they came up with for the income is probably okay. All right. Audit risks. I can't remember if we talked about this already. Maybe we did. Auditing risks. There are 3 risks that go into audit risk. Oh, I don't want to say control. Let me. Don't write this in yet. I need a cinnamon. Cinnamon. I need a cinnamon. That's not what I want. I know, client responsibility. Okay, client's responsibility are for the first 2. And I'll talk about what those are in a second. Okay, client responsibility, auditor responsibility. Inherent risk. The risk that a material misstatement will occur. Okay, so yeah, another S in here. Inherent risk is the risk that a click on it. Inherent risk is the risk that a material misstatement will occur. Okay, now for all risks, do you want risks to be high or low?
Low.
Low. So it's never to have any risk as low as possible. You know, low is what you're looking for risk. So you want this to be low. The risk that a material misstatement will occur, hopefully that doesn't happen very often. So you want that inherent risk to be low. Control risk, the risk that clients internal controls will fail detect. Shouldn't say detect, identify. Material misstatement. So inherent risk, the risk that material misstatement will occur. Control risk is the risk that the client's control will fail to identify. I mean, you can also maybe identify or prevent a material misstatement. So inherent risk that material misstatement will happen. And if that does happen, you hopefully the controls that the client has will identify or prevent a material misstatement. Now, if they fail, that's bad. So if they fail, that's a bad risk. So the first one is, will it occur? Second one is, will the controls fail? So notice what happens if both of those happen. If a material misstatement occurs and the controls fail to recognize it or identify it or prevent it, then it's up to the auditors to get it. Okay, the auditor's responsibility is for detection risk. Is risk that the auditor will fail to detect misstatement. Okay, so the client's responsibility is to have an inherent risk be low and control risk be low, hopefully. And should those fail, it's up to the auditors to detect the material misstatement. And if they fail, that leads into audit risk. Which, I'll go ahead and finish it out here and then we'll talk about what it means. Audit risk. Built a risk that and undetected material misstatement on financial statements. Okay. So audit risk is kind of like the end result that happens if the clients fail and if the auditors fail, it ends up being audit risk. Try and put that separately. The heck? Sorry, my formatting on this last one was not. It still isn't, even. Okay, so audit risk is risk that a material misstatement will appear on the financial statements. Now, you'll notice something here. And this goes back to this first thing up here. we assess the risks. Okay, so we're assessing the risk, and what we're doing when we assess the risk is it's here. These are the risks that we are assessing. We assess the risks. This is what we're talking about. You know, the inherent risk and the control risk. We're looking at what these client's responsibilities are. Now, notice that we cannot change those. We cannot change it. We can change our assessment of it, but the actual inherent risk and the actual control risk, we cannot actually change it. And you say, well, why can't we change it? Well, we can't change it because this has already happened. Remember, this is during the year. You know, what was the control risk, inherent risk during the year, and what were the control risks during the year? So we can only assess it. And the only one really that has any control over it going into the next year is the client. So this is the only thing that the auditor has responsibility for, and this is what we use the you know, the further procedures up here, perform further audit procedures like sampling and all that kind of stuff. This is what we, you know, the auditor's responsibility is what we do to figure out whether these are misstated. And so these are the procedures. Like sampling and so forth. Yeah, the sampling is the only one we've been using, so I'll leave that. So we assess these control risks for the client. And the detection risk is the only thing that we control. We don't control these other two. Yeah, you know, so for instance, if they had weak internal controls from January through August, say, you know, they could have through the entire year, but you know, notice that even if they corrected the controls by year end, it doesn't change the fact that those controls were lacking, you know, up through August or whatever. You can't jump in the time machine, go back and change that. You know, it's already done. So we are really just assessing the risk of what, you know, of what risks, what are the possibilities in that of a problem happening with financial statements. We're assessing it. We can't change it. Sometimes you'll read CPA questions, they'll talk about changing the inherent risk or changing the control risk. You know that that's a, you know, a bad answer, because you can't change those. You can change the assessment of it. If you find out that their controls are better than you thought they were, or worse, you could change your assessment, but you actually can't change the actual, you know, the actual risk, the actual, whatever the true amount is, you can't change it. Okay. I'm not gonna be able to put this on the same page, I don't think. Okay, I'm gonna go on to the next page here and figure out what to do with it later. Okay, there is a mathematical formula that has appeared on the CPA exam. And that is if you multiply the inherent risk times the control risk times the detection risk, you come up with the audit risk. Okay, so this will look like this. So inherent risk is 40%, which seems very high, but times the control risk, which is 50% here. Again, a very high. Times the detection risk, which is 20%. Oops. Let's try that again. And this will give us our audit risk. Shoot, I picked up my phone. My phone somewhere. I got a little calculator here. All right. Let's see, 0.04. 0.04. You guys got it? You want to check that. So the audit risk would come out to be 0.4. Is that what you guys got?
Yes.
So this would be, you know, our audit risk here, you multiply those out and the audit risk would be 4%. So you can kind of see how this works out, though, that this, you know, even with these extremely high risks, you can get the audit risk down fairly low because, you know, there is this kind of multiplication effect of it. And that's one reason why auditing is so efficient, you know, that you don't have to look at every single thing that, again, you know, you look at 40 and, you know, 50% effectiveness, you still get it down pretty low, even with a detection risk of 20%. So, okay. Client acceptance. There's a few things that go into accepting a client. In many businesses, whoever shows up, you know, if you're working at Burger King, whoever shows up and they want French fries, you give them French fries. It's, you know, they pay the money, whatever. It's not like that with auditing, and that's one thing that some people in business have a hard time with, is that you have to pick and choose who you take as clients. And one of the biggest things is the integrity of the client. And the AICPA really comes down hard on this. On the CPA exam, the integrity of the client is, you know, the most important thing. Like, you know, if you want to avoid trouble, be careful in which clients you take. And it's not just because, you know, you don't want to be associated with those people. You got to realize too that that has a reflection on the profession as a whole, but also your other clients. If you take somebody who is of questionable repute, any audit that you do is going to be questionable. The only thing we give to audits are credibility. So it is very important to pick and choose which clients you take. Now, there's also the problem of, you know, are you qualified to take the audit? There's a few other things that go in here, which we're going to talk about in a second. But it's not just, you know, someone shows up and says, hey, I need you to do an audit. And there's a lot of times people don't understand what that, you know, entails. Maybe their bank said we need to have audited financial statements, and they say, oh, okay, you go to a CPA, but I need an audit. You know, you come over here next week, and you know, it's not like that. Okay, so first thing, is the CPA firm qualified? Can the audit be completed? Now, depending on the different types of industry that they have, your firm may specialize in different types of audits. So, for instance, TPA may specialize in retail sales. So if it's a retail sale business, you know, they may not have a problem with it. So if it's a retail store and they've done many retail, they may do it again. Now, suppose they don't have any expertise in it. So someone says that they own a tree farm and they grow trees, and it takes, you know, 3 years, and then they harvest the trees and they get them planted all over and whatever. Can you take an audit that is not your specialization? And the answer is yes, as long as you believe that you can become familiar enough to complete the audit. So as long as the auditor believes they can obtain the required expertise to complete it. And it could be through, research. It could be hiring a specialist. There could, yeah, any way that they can figure out how to do it. Is fine, as long as they believe that they can complete the audit. If they don't believe they can complete the audit and give an opinion, they shouldn't do it. But if they believe that they can obtain required expertise, then they can take it. And if you think about it, for instance, let's say the tree farming thing. If you don't have any clients that are doing tree farming, there'd be no reason for you to get, to specialize in that until you do have a client that's in tree farming. You don't want to be specialized in something that you never use your entire life and spend all your money, trying to get up to snuff on auditing tree farms when you don't have any tree farm clients. So these kind of go hand in hand. That it isn't like, oh, this is bad for the people getting the audit. No, a lot of times it's helpful to people getting audit. It's more people into the field that can, competitive nature of auditing, that you can have more than one audit firm to go to try to get your audit done. And again, as long as they can get up to speed on the audit, and they believe that they can perform it and render an opinion, they can certainly take the audit. Now, if they don't think they can, then no. Okay, legal and ethical requirements. We kind of talked about this in chapter 3. Independence. It's a big one, obviously. Other clients lost it. Yeah. If you have other clients that are competitors, and they may have lawsuits between them. These are all kinds of things that you look and see if you ethically can take it. Ownership, well, that goes into independence. But independence certainly from employment and investment and all that kind of stuff. Those all come into play. So basically the chapter 3 stuff. Okay, number 3 is probably the most important one, and the AICPA will undoubtedly tell you this is the most important one. The integrity and reputation of the client. If you ever see a CPA question, they say, which one of these is most important, and they have integrity of the client, that's the answer. It's virtually always going to be the integrity of the client. That's the most overriding thing, is the integrity of the client. You cannot be associated with people of ill repute. Okay, now we got to keep a few things straight here, and that is the successor auditor. If there was an auditor in the past and you're a new auditor, the successor auditor is the new auditor. The predecessor is the old auditor. Now, the successor auditor is a new auditor, predecessor is the old auditor. Now, these two are required to get along, basically. So the successor auditor and the old auditor are sort of, there's a professional agreement, basically, that these two will help each other. The old one will help the new one. Now, the successor auditor is going to contact the predecessor. So if there is a previous auditor, the successor auditor must contact the predecessor. And they do this before taking the audit. So if they already have a predecessor auditor, there's also already somebody in there. Now, if there was no previous auditor, obviously you don't, there's no one to contact. If it's their first audit ever, there's no one to contact. Which then you have to contact the predecessor auditor. Okay, and if it's publicly traded, you will get what's called an 8K report. And the 8K report will have in it any let's not do that. There we go. An 8K report is filed with the SEC. And it's for anything that a company does. Whenever a company has a big change, they file an 8K. So for instance, if a company buys a competitor, they file an 8K. If the company sells one of their brands to somebody else, they fill out an 8K. If the operations manager leaves, operations director or whatever, if they leave, they fill out an 8K. So whenever there's any kind of significant change in the company, they fill out an 8K. Well, one of those significant things is if they change auditors. And so if they change auditors, they fill out an 8K. And the 8K is basically telling the SEC that, hey, look, there's a change in our company. It could be for a number of different things, but one of the things is if they change auditors. So if they change auditors, they contact the SEC. The SEC, with this 8K report, they tell them, look, our auditors are no longer these people, it's these people. And you don't really have to tell why it is or anything like that. It's just basically telling them this is the change. And the same thing for the other things. If the chief financial officer leaves, you don't have to say why they left. Who knows? They'll raise goats in Colorado or something. But whatever it is, you don't need to go into why. You're just telling them, look, here's the change. And the same way with audit. So there's an 8K report. Okay, so some of this other stuff, though, this is what you're going to talk directly to the other auditors, the previous auditor. And again, the big one here is the integrity. I'm gonna bold all these. The integrity of management is the big one. Can you trust management? Ask them for the reason of the change. Sometimes it's just somebody wants to retire, the auditor's retiring or something. It could be any number of reasons. Ask them about any disagreements. Communications with the company, their board of directors, or with management. And one of these is related party transactions, unusual transactions. And a lot of times, especially in non-publicly traded companies, you do have a lot of these related party transactions. It's just way, especially family businesses and things like that, you'll find all kinds of wacky stuff, car loans to grandma and all that kind of stuff on the books. So, sometimes you gotta be a little bit careful with those types of things, just to know what you're getting into. Okay, so, but anyway, contacting the predecessor CV, this is actually a very important one, and this is, you usually get the best information from the previous, the predecessor auditor. You probably have to pay them, some fee for them to do their work and to sit down with you and take the time and all that kind of stuff. But again, that's, to make sure that you are making a good choice and taking this client, you have to do that. Talking with third parties like bankers on that, background searches, you can actually have places that will do that for you, do background searches on people. This is kind of a big one. Shopping for accounting principles. shopping for accounting principles is when usually when there's a disagreement with the current auditors. So shopping for accounting principles is when the client looks for a CPA firm that will agree with their disputed accounting principles. So, a lot of times this comes down to people pounding on tables. Well, this is revenues, and the others say, no, it's not revenue. Yes, it is. Well, you know what? You're not the only CPA firm in the world. I'm going to find another CPA firm. And so what they do is they start calling around. They say, by the way, we account for revenue this way. Do you have a problem with that? And they're, what they're doing is shopping for accounting. They're trying to find somebody who will agree with whatever disputed accounting principle they're looking at. So shopping for accounting principles, it's very much frowned upon by the AICPA, but it is something that can happen, in that they look around to find a CPA firm that will allow them to use the principles they want to use. And usually it comes about because, again, there's a disagreement with the current auditors. Okay, client continuance. There are sometimes you get a bad client that you want to not continue with. So you get into the audit, you think everything's going to be okay, you end up that it's going to be a nightmare, and whatever. You might say, do we really want to keep this person as a client, these people as a client? So client continuance is actually a very important thing as far as whether you want to keep them keep going with a client. Now, you have to make that decision fairly early usually. And what I mean by that is you can't leave them in the lurch and come December say, oh, guess what, we're not going to do your audit. Usually you're trying to tell them ahead of time that I had to find somebody else, because you can't leave. There's professional rules, professional law. I actually have a good case on that. I'll show to you next week. But the professional reason why you can't just leave a client, it's kind of like being a doctor. If you get a bad patient, you go and you're doing a surgery and you think it's gonna be a real easy surgery, you open them up and, oh my gosh, the doctor can't just run out of the room. They have an obligation to help their patient as much as they can. We have the same kinds of rules for auditing. We can't just leave a client because we don't like some of the stuff they do or whatever, whatever it is. You have this responsibility for them, and allow them to get somebody else to come in and do the audit for them. Okay. All right, here's some multiple choice questions. The attempt to communicate between the successor and predecessor auditor to be initiated by which one?
Successor?
Yep. The predecessor has no responsibility to contact the successor. The successor must contact it. And by the way, I didn't mention this, and I should. The client has to give permission for the predecessor to speak to the successor. Okay, so the client must give permission to allow you to speak to predecessor auditor. So the predecessor, the predecessor will say, well, yeah, have the client send over the release and we'll talk to you. Now, suppose you get a client that doesn't want to release it and says, no, I don't want you talking to those guys. Those guys are jerks. If I got to pay a little bit more for the audit, that's fine. Those guys are idiots. I don't want you talking. You got to explain to them, look, anytime someone puts a scope limitation, I don't want you seeing this or talking to these people or whatever, it raises red flags. Now, maybe they are jerks. Yes, does that happen? Yeah, of course it happens. But you need to be able to talk to the predecessor auditor. And if they don't, generally speaking, you don't take the audit. Now, there is a possibility that they can't speak to the predecessor auditor. Maybe the auditor died. Maybe the auditor left the country. Maybe the auditor went to jail or whatever. There are reasons why you may not be able to talk to them, but generally the client doesn't control those. So the client needs to authorize you to talk to the previous auditor. Okay, and the attempt to communicate between the successor predecessor should be made before the audit engagement is accepted or after.
Before?
Yep, you're required to do it before it's accepted. Okay, the assessor auditor inquiry about which of the following. Generally the big stuff. No, you're not gonna get into specifics about anything, but disagreements with management, definitely gonna look at those.
Reasons to change in auditors.
Yep, absolutely. It's an important one.
Integrity of the management.
Yep. And the communications. So, what was it like talking to management? Oops. And what was it like? Communication with those in charge of governance, which is the ACCT's term for board of directors. So governance is what they will often say when they mean these people. You're not going to ask them about specific audit steps. You're going to do your own audit steps and testing of accounts and like stuff. Okay, AK report. I really didn't talk too much about that, but I kind of go through these. The AK report. So this is a report that's sent to the SEC, and this is only for publicly traded companies, issuers, as we call them. And what will they tell them? They'll tell them that there's a change in auditors. They will not tell them for the reason for the change. They won't tell them fees. Significant disagreements. They will tell them that, but they will tell it to them for the last 3 years. And they will have the predecessor's response to specific disagreements. So they'll say what the disagreements were. And the predecessor's response to them. So they really don't get too much into it, other than the disagreements. They don't get too much into any, the how much were they paid, why you're changing, anything like that. But the significant agreements, and by the way, the significant agreements, the way that comes about is the company files that and says, here are the significant disagreements. The SEC gives it to the predecessor auditor, the old auditor, and says, is this everything? And it's a yes or no response. So the response that they're talking about is basically saying yes or no. And it's good, if they're gonna, for the SEC to accept it, it's gonna have to be a yes. Because what happens is, if the auditors say no, there's more, the SEC does not ask the auditors what it is. The SEC goes right back to the client, the company, and says, okay, you're not telling us everything, what else are you not telling us? And then, until finally they'll put enough on there that the predecessor CPA firm will agree to it. But it's a yes or no for the audit firm. They don't say, oh, but this and this and this. The company has to tell the SEC. The auditors just say yes or no. Okay, let's finish this one, then we'll call it a day on this handout. Which of the following consideration is important when obtaining new clients? Engagement risk. Okay, how about A? Is that important?
Yes.
Yep. B, nationality of the owners.
No.
Credit rating. This is actually going to be a yes. And it's not that you think you're not going to get paid. It's because, for instance, let's say a client is doing poorly and maybe it looks like they may be going into bankruptcy or something like that. They have a poor credit rating. Companies that are going bankrupt are riskier because they have more incentive to cook the books, right? I mean, a company that's doing really well, hey, take a look at them, right? Didn't we do great? But a company that's not doing very well, oftentimes, they have more of an incentive to try to say cook the book, so the risk would go up, and so the risk might be enough that you say, okay, the risk is too much. Marital status of the owners.
No.
Pending litigation.
Yes.
Yeah, litigation is, and it could be, depending on who is suing who. Independence.
Yes.
Yep, it's all chapter 3 stuff. And auditor's competence in the client's industry.
Yes.
Yep. Now, even if they aren't competent, if they think they can become competent, they can still take it, but it is a consideration. If it's a new type of business. Okay, I'm gonna say stop here. Okay, so we will stop here, and I think the next thing we'll do, we'll finish up that monetary unit sampling. Hopefully we get out a little early tonight, we'll see. Monetary unit sampling, I think we still need to do number 6 and 7, I think. All right, so let's say what time is it? 6:50. Let's say 7:10. Be back at 7:10. All right. Okay, we'll go through number 6 and then we'll talk about some stuff later on here. Okay, so monetary sampling. Monetary unit sampling, I should say. All right, so here is the, so here we have the interval. Oh, here's a question. How many items were in the sample? The interval is 100,000. So how many items we have in our sample?
$20.
Very good. Yeah, so 2 million divided by the 100,000 means that we must have had 20 items. And of those 20 items, the 3 down below here were the three that we found that had problems. So these are obviously not all of them. The other 17 must have been fine. Okay. The first one is tricky. What do we do with that one? Give you a hint. This is something that we're not supposed to be able to find with this method.
And this is an understatement.
Yeah, this is an understatement. We're not supposed to find these with this. And when we do find them, we ignore it, which again, as an auditor, this really well, it bugs me anyways. It finds something it's wrong and they say, no, yeah, it's off, but we're not looking for those. So there actually is no misstatement. Okay, the second one, we can just go ahead and so everything's normal here. It's an overstatement. It's not bigger than the interval. So this one is, say we're saying that the rejected misstatement is 25,000. Number 3 is wacky. What's strange about number 3?
The book value is higher.
Yeah, the book value is higher than the interval. So it covers the entire interval and then some. This may actually even be picked up on 2 different it may have been chosen twice, it's possible. But it's bigger than the interval. So at this point, we go to the actual misstatement of the item, which is simply the 108,000 minus the 95. Oops, no, that's right. And this will be our misstatement. $13,000. Okay, so 13,000 is so when it is more than the interval, at that point we stop. And we say, okay, that we're going to take the actual amount that it is. And may as well do the included in the incremental allowance. We'll do that right now, I guess. Okay, well, first one doesn't really matter, even if it was a yes, because the misstatement is 0, so this would be no. Now, it goes by, these intervals are kind of like separate samples. So the interval is a sample in and of itself. We've taken the entire population and broken it up into these little sample chunks. So in those sample chunks, could something else go wrong? And it depends on how much of the sample you've taken. So in this case, we've taken 20,000 of it. So there's another 80,000 in there. So could something else go wrong? Yeah, there could be more things in a sample. And if something has been found to be wrong, it increases the likelihood that something else will be wrong. Now, when it comes down to this one, they've taken 100% of everything in that interval and then some. So they've taken 100% of the entire interval. Nothing else could go wrong. Now we know it's off by 13,000. We got that in our rejected misstatement, but nothing else could go wrong in here. They've covered the entire $100,000 interval. It's sort of like taking 100% of the items. So this one will not be included in the incremental allowance below. This incremental allowance down here. It will not be included in that. Kind of punched up here. Okay, so the projected misstatement is 25,000 plus 13 is 38,000. $25 plus 13 is 38. Okay, basic precision. Here and grab the formula for basic precision at the very end, unfortunately. Basic precision says, okay, if there was nothing wrong, center, basic precision says if there's nothing, if you didn't find any errors, this could still be off by some amount. And so you take the interval, which is 100,000. Times the reliability factor at line 0, let's see, was it 10%? I don't have the title on this thing. They cut off too much off of it. Okay, so 10% at 0. So again, this is if we didn't have any misstatements. There's a still possibility that this would be off by some amount. So 2.31 is going to be what we multiply by it. And so that will equal our basic precision to 231,000. So even if we didn't have any errors, so we know we had 38,000 in errors, but even if we didn't have any errors, there's still the possibility that this would be off by 231,000. Why? Because it's a sample. You know, unless we do 100%, we're not going to know. Okay. Well, we only need to find the overstatement of the incremental allowance for one of these because there's only one that's a yes. So when we come down here to this incremental allowance, we only really need to do the number 1. There's only one of them that is. So overstatement at 1. .89 minus 2.31. Don't forget the 1 minus the 1. Some number. Yeah. Turn the calculator on first. Everybody write that down. Okay, with my calculator turned down, that's like 0.58. And the first, and actually the only one we have, is going to be this the 25,000. There is no incremental allowance for this other misstatement here because it covered the entire sample, took 100%. There's nothing else could be wrong in that sample, that chunk of the sample, that 100,000. Okay, so 0.58 times 25,000. That comes to 14,500.
Yes.
Oh, wait, wrong place. Okay. I'll keep it. Okay, so the incremental allowance. So this is the and this has to go by the idea that if there is a misstatement, that means that at least in that sample, if there's one, that means there could be more. And so it increases the chances of something else going wrong. So basic precision is, if we don't find anything, it still could be off by some because it's a sample. This one is, okay, we have to add a little bit, because if we do find any of these samples that could have things that are more wrong with them, it could increase the amount of error basically we're looking at. Okay, so copy all this down. Eliminating some of this stuff here. Okay. All right, so all three of these together will give us this. Okay, 283,500. Time. Okay, I think that's right. Okay, so this is 283,500 is out of what, 2 million? That's quite a bit. That's probably material, but the CPA exam will not ask you if that's material or not. But you should come up with that answer. And by the way, the CPA exam, they have given problems like this on it. I don't know whether they have lately. I know that they have in the past, and this one is actually based on ones they gave out in the past. Okay. Well, so wrapping this up, the advantages and disadvantages. One of the big advantages of monetary unit is that if you don't have very many misstatements, you get a smaller sample, and sometimes much smaller. Automatic certification of the sample, it automatically picks the ones that are larger more often. And if they get to a certain size, it's 100%, it'll pick those items. So the more material they are, the more likely they'll get picked. And up to us, and if they go larger than the interval, is 100% they'll be picked. Disadvantages, this is a big one. This is the biggest one. Cannot be used for understatements. And also we have here, the sample size is not easily expanded, in that if you, a lot of times when you're doing a sample, if you do come up that there's a problem, a lot of times you want to be more sure. So let's say that you're auditing, let's say you're doing it at the 90% level, and you come up that something is misstated. Well, before you go, crying wolf to the client saying that their books are misstated, you may want to expand the samples. Okay, let's, instead of going at 90%, let's go at 95% or 99%. And you expand the sample and see if you come up with the same results. You want to get more sure of yourself before you go in, to talk with the client about possibly having the books up. you can't really do that with monetary unit sampling, and there's a good reason why. You'll notice that if you change the sample size, you're also going to change the interval. You're going to choose different items. You know, if the interval goes from being 100,000 to 62,000 or whatever, you're going to pick different items when you pick your sample. So it's not easily expanded. Whereas classical sampling, if you pick random, you know, if you pick 20 random accounts, and you say, okay, well, we came up with a big problem here, but let's be more sure. Let's pick up, you know, let's do 50 accounts. Randomly pick 30 more accounts and see what you come up with. The monetary unit sampling is not so easy. You can't do that because it actually it'll change your sample. Okay. Classical sampling. If they do have a lot of errors in the sample, you can get smaller sizes for classical sampling. So it handles variation better. Items with negative balances and that require special consideration. I don't agree with this one because usually the negative balances usually means that they're misclassified. What I mean by that is, for instance, let's say you have an accounts receivable that has a negative balance. That means you owe the customer. That's a misclassification. That should be a liability. That should be a payable rather than an accounts receivable. So a lot of times negative balances, it's that they're misclassified rather than it's a problem with the sample. This is the big one. Can be used for understatements and overstatements. And we just talked about this. The size can be easily expanded. Disadvantages, you must estimate the standard deviation before you find your sample size. Stratifications may be needed. Look at larger items versus smaller items. Auditing standards do not advocate one technique, you know, other they simply are using different circumstances. Okay, so basically you have your choice between classical sampling and monetary units. And again, there are advantages of each one of them. How about this? If you were unsure whether it's an overstatement or an understatement, let's say this is your client, the first year you're doing the audit, and you're not exactly sure whether there's more of a risk of an overstatement, they try to make themselves look better, or understatement, they try to make themselves look worse, maybe to save on taxes or something. Which sampling would you do if you're unsure of whether it's an overstatement or understatement?
Classical.
Yeah, the classical will tell you which way it's going. The monetary unit will only tell you if it is overstated. So if you're not sure, classical sampling is a good one to use. Okay. Hey, we're done. Do I have this one in assignments? Can't remember. Oop, yes, I do. Okay, so you can turn this one in, the monetary unit sampling. So we're not going to turn anything. So yeah, you can turn the monetary unit sampling in. Chapter 5 we finished last week. Chapter 6 we're going to still work on it. Hopefully we'll finish it by next week. And there's actually two more. I gotta get moving on those statistics because there are actually two more handouts to do for stats before we take the test of it. I should have it done by this week, or well, what is it? Like, they usually get done like 11 or 12. But anyway, So next week, we're gonna do an overview of it. So, any questions on this? All right, we'll get out a little early. That'll help to make up for these times I kept you too long. So nothing to turn in, you can turn in the chapter, or no, the Monterey unit sampling we just finished up there. You turn that in. And, but nothing for chapter 6, we're not done with it. All right, any questions?
Nah, appreciate it, Professor. Have a good night.
Good night, see you guys,
Thank you.
Thanks. Have a good night.
see you guys.